Hi everyone, in this video we'll be going over A-Level Accounting 2023, Specimen Paper 3, question number 2. And paper 3 is quite different from this year onwards because previously we used to have 6 questions, each of 25 marks, and 4 of them were of financial accounting, whereas 2 of them were of cost and management accounting. But from this year onwards, the previous paper 3 is being split up into 2 papers, paper 3 and paper 4, and paper 3 will consist of 3 questions, each of 25 marks, only relating to financial accounting. So we have the total weightage of 75 marks and we're given a time limit of 1 hour and 30 minutes. So ideally, we should be spending about 30 minutes for each question. And in this video as well, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. ZPLC had the following balances at 1st January 2020. We are given the balances for equity, ordinary share capital, whose nominal rate is 2 per share, general reserve, retained earnings, and 4% debenture, which is repayable in the year 2031. Let's have a look at our first question. We need to state 2 reasons why a business may have non-current liabilities, even though it also has substantial retained earnings. Okay, so the first thing we need to understand is retained earnings is basically the accumulation of profit. And profit is not the same thing as cash, because in profit we utilize our accrual concept as well, which means that we also record those amount which we have not received yet, which means that it is not equal to the cash holdings that our company has. And this is the first reason why a business may have non-current liabilities in order to bring in cash, even though it has substantial retained earnings. Let's write it down. Retained earnings are not the same as cash. And secondly, a business might require additional cash in order to invest in other assets, such as non-current assets or inventory, right? Due to that particular reason as well, business may take out some non-current liabilities. Let's write it down. The business may have invested in other assets, such as non-current assets or inventory. Okay, let's move towards the second part. We're given additional information. Let's have a look at the question first. We need to prepare the statement of changes in equity for the year ended 31st December 2020. A total column is also required. So let's prepare the format. We are preparing the statement of changes in equity for ZPLC and statement of changes in equity. And this is for the year ended 31st December 2020. Okay, so we were told that we also require the total column. So that's going to be the total column. Okay, then the final column we will write down is of retained earnings. Then we are also given our general reserve. And then we have our share premium. And the first column is going to be ordinary share capital. Okay, and let's have a look above. So we can see that all of these amounts are in thousands, so we can prepare our statement of changes in equity in thousands as well. Let's write it down. So that will be in 1000 for each column. Okay, now we can start with our opening balance, which will be at the date of 1st January 2020. And information regarding this was given at the beginning of this question. So we're just going to copy that amount. Right here, we can see that our ordinary share capital is of 500,000, general reserve is of 40,000, and retained earnings is of 460,000. And this is debenture, which we do not include in our statement of changes in equity, so we can just ignore this for now. Let's write down these amounts as the opening balances in our statement of changes in equity. For ordinary share capital, that was 500,000, so we can just write down 500. We didn't have any share premium. Then we were given the general reserve balance to be 40,000. And the retained earnings balance to be 460,000. So the total is just going to be the sum of these three amounts. So that's 500 plus 40 plus 460, which results in 1,000. Now we can move towards our additional information. So during the year, a long-term bank loan, 250,000 was taken. The interest charged on this loan by the year end was 14,000. Okay, so anything regarding our long-term bank loan is non-current liabilities, which will not be included in our statement of changes in equity. So we can just ignore this information for now. Then secondly, we have an interim ordinary dividend of 0.06 per share was paid on all issued shares at 1st January 2020. So this just means that in order to figure out the total interim ordinary dividend paid, we just need to multiply this rate to our number of shares that were issued at the date of 1st January 2020. Now, in order to figure out our number of shares, we just divide the total value by our nominal rate. So in this case, at the date of 1st January 2020, our number of ordinary share is going to be 500,000, which is its total value, divided by the nominal rate, which is 2. And this gives the number of ordinary shares to be 250,000. Now we just need to multiply this number of ordinary shares by the dividend rate in order to figure out the total dividend paid. So our dividend paid is just going to be rate, that is 0.06, times the number of ordinary shares, which is 250,000, which results in 15,000. And we record our dividends paid in our statement of changes in equity since dividends are paid out from the retained earnings. So we just need to subtract this amount of 15,000 from the retained earnings column. Let's do it. So we have our ordinary interim dividend paid. And it was a 15,000. So we only subtract the 15,000 from retained earnings column, and all the other columns of ordinary share capital, share premium, and general reserve is unaffected. So the total is also going to be negative 15. All right. Now we can have a look at another information. The taxation charge for the year was 10,000. Again, taxation is also not included in our statement of changes in equity, so we can just skip this information for now. Then 200,000 shares were issued at a premium of 0.75 per share. We know that our nominal rate is $2. So let's figure out the value to be included in our ordinary share capital due to this issue. That is just going to be the number of total shares issued times the nominal rate. In this case, that will be 200,000 times 2, which results in 400,000. So our ordinary share capital will be increased by 400,000. And since we are issuing this at a premium, our share premium will also increase. So the share premium will increase by the number of shares issued, which is 200,000, times the premium rate. In this case, that's 0.75. And this results in the amount of 150,000. So we just need to include this amount of 400,000 in our ordinary share capital column and 150,000 in our share premium column due to this issuance of new shares. Let's write it down. We can write it as issue of shares. And we need to add 400,000 in our ordinary share capital and 150,000 in share premium. And general reserve and retained earnings column will be unaffected. So the total is just going to be 400 plus 150, which results in 550. All right. Then profit from operations was 105,000. Remember that we do not include our profit from operations, but we do include the profit for the year in the retained earnings column, right? Which means that we now need to figure out the profit for the year. So if we start from the profit from operations, We need to reduce all of our finance charges as well as the tax paid in order to figure out the profit for the year, right? And we're given the profit from operations to be 105,000. Let's write it down. We are also given our finance charges, and finance charges is basically the interest paid, right? And we are given the interest charge on the long-term bank loan to be 14,000. But we also have our 4% debenture on which we need to pay the interest, right? So let's figure out the interest on debenture. That will be the total amount, which is 400,000, times the rate of the debenture. In this case, that's 4%. So we can write it down as 0.04, which results in 16,000. So we also need to include this in our finance charges. So that will be 16,000 for our debenture and 14,000 for the long-term loan. Let's write it down. That will be 16,000 plus 14,000. And then we are also given information regarding tax. The taxation charge for the year was 10,000. So we need to subtract this amount as well. All right, so this is just going to be 105,000 minus 30,000 minus 10,000, which results in 65,000. And we need to include this amount of 65,000 as our profit for the year in the retained earnings column. Let's do that. So this is the profit for the year, and it only affects our retained earnings column, which is 65. So the total for this row is also going to be 65. Okay, then we utilize this information, this as well, this till 5. All right, then a transfer to general reserve 25,000 was made. This just means that we take 25,000 from the retained earnings and just put it into our general reserve. So we just need to subtract 25,000 from the retained earnings column and add 25,000 to the general reserve column. Let's do that. So we can write it down as transfer to general reserve. And we need to subtract 25,000 from the retained earnings and add 25,000 to the general reserve. And our ordinary share capital and share premium will remain unaffected. So the total for this row is going to be 25 minus 25, which results in 0. Now let's have a look at the final information. A final dividend of 0.08 per share was proposed on all issued shares at 31st December 2020. So the key word here is proposed. We have not yet paid this final dividend of 0.08 per share, which means that our retained earnings is going to remain intact. This information should not be adjusted in our statement of changes in equity. This just means that we completed all of our items to be included in the statement of changes in equity. So we need to figure out the closing balances for each column. Let's do that. So this will be at 31st December 2020. Okay, and for the ordinary share capital column, that will be the sum of these two amounts. That's 500 plus 400, which results in 900. For share premium, that is just 150, right? For general reserve, that will be the sum of these two amounts, 40 plus 25, which results in 65. For our retained earnings, that will be the sum of these four amounts. So that's 460 minus 15 plus 65 minus 25, which results in 485. And now for the total column, that is going to be the sum of these five amounts. So that's 1000 minus 15 plus 550 plus 65 minus 0, which results in 1600. Okay, now in order to check whether our statement of changes in equities calculation is correct or not, we can just add these four amounts in order to see if our total is 1600 from this side as well. And in this case, we can clearly see that 900 plus 150 plus 65 plus 485 results in 1600. So we can conclude that our statement of changes in equity is correct. Now we can move towards the next part. We need to calculate to 2 decimal places the gearing ratio of Z plc at 31st December 2020. Okay, the formula for gearing ratio is non-current liabilities divided by non-current liabilities plus equity times 100%. Okay, let's figure out the total non-current liabilities at the date of 31st December 2020. we have our long-term bank loan of 250,000, which is given right here. And we also have the debentures of 400,000. So our total non-current liabilities is going to be 400,000 plus 250,000, which results in 650,000. Okay, let's write this amount down. That's 650,000 divided by 650,000 plus the total equity. We just figured out our statement of changes in equity, and the total is 1600. So that's 1,600,000. Let's write it down. This means that the gearing ratio is just going to be 650,000 divided by 650,000 plus 1,600,000 times 100%, which results in 28.89. Now for the second part, we need to calculate the interest cover ratio, and the formula for interest cover ratio is profit from operations divided by the total finance charge or interest charge, right? And we are given the information regarding profit from operations. So profit from operations was 105,000. Let's write it down. And the interest charges were also given, which is basically the finance charge, right? And that was 16,000 plus 14,000, which results in 30,000. So let's write this amount down as well. Now the interest cover ratio of ZPLC at 31st December 2020 is going to be 105,000 divided by 30,000, which results in 3.5. And the unit for the interest cover ratio is times. So let's write it down as well. Now we can move towards the fourth part. We're given additional information. The business had issued the shares and taken out the bank loan in order to finance an extension to the factory. At the annual general meeting, one shareholder stated that rather than issuing shares, the company should have financed the extension entirely by taking out long-term bank loans. We need to calculate to two decimal places the revised gearing ratio if the shareholder's proposal had been adopted. So what this question means is that we need to calculate the gearing ratio. Again, the formula is the same one. Non-current liabilities divided by non-current liabilities plus equity times 100%. But in this case, whatever amount that we took out by issuing new shares, those should have been treated as the non-current liabilities. So let's do that. Our new non-current liabilities now will be the previous amount of 650,000 plus the new issuance of shares, from which we got 400,000 and 150,000 each for ordinary share as well as share premium. So we need to treat these amounts as non-current liabilities now. And this gives the total non-current liabilities, 1,200,000. Let's write it down. And now for the equity part, previously we had the equity value of 1,600, right? And from this we need to subtract the issue of shares, which was 550. So let's subtract that. And that results in 1,050. So the new equity value is going to be 1,050,000. Let's write it down. So the revised gearing ratio will be 1,200,000 divided by 1,200,000 plus 1,050,000 times 100%, which results in 53.33%. Let's move towards the second part. We need to advise the directors whether or not they should agree with the shareholder. So firstly, we just saw that our revised gearing ratio is 53.33%, which is greater than 50%. And this just means that our total non-current liabilities has a higher value than that of our equity. That makes the company very risky. Let's write it down. Gearing has increased, making the company more risky. And it is more risky because if our non-current liabilities is higher than equity, then we have lower chances of paying those liabilities, right? And since there is an increase in risks due to the higher amount of non-current liabilities, and non-current liabilities needs interest payments, which means that the interest rate on those loans could be higher, which is again a negative aspect to the company. Let's write it down. The increase in risk might have led to a higher rate of interest of the loans. Now let's talk about issuance of share. When we issue new shares, then obviously there are going to be new shareholders added to the company, which could dilute the control of the company. Let's write it down. The share issue will have led to a dilution of control. And by issuing shares, our total value will increase. Also, the number of total shares is going to increase, right? And due to higher amount of shares, maybe there will be a lower dividend per share in the future because every shareholder requires a dividend, right? Let's write it down as well. Issuing the shares may result in a lower dividend per share in the future. Now, based on these factors, we need to advise the directors whether or not they should agree with the shareholder on financing the extension of the factory by only taking out non-current liabilities. And personally, I would suggest the directors to agree with the shareholder because although there will be higher loan interest, there is no requirement to pay a dividend, right? So that could be an advantage. Let's write our decision clearly. The directors should agree with the shareholder. Now we can move towards the fifth part. We need to state two factors a bank might consider when a business applies for a loan. So the very first thing they would consider is the profitability of the business, because if the business is making a loss, then there is a high chance of bank not considering the loan. The profitability of the business. And the second thing they would consider would be the cash flow of the business as well. Because like I said before, profit and cash flow is not the same thing, because profit incorporates accrual concept, but cash registers all of our cash inflows and outflows only. So they also need to know the state of cash flows in the business. All right, this concludes the second question for 2023 Specimen Paper 3. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.